Want to buy or sell crypto at a specific price instead of whatever the market offers? That's where limit orders come in. Unlike market orders, which execute instantly at the best available price, limit orders let you set your own price and wait for the market to beat it. Placing one is simple on Binance, BYBIT, and other platforms. Head to the professional trading screen on Binance, that's trade, spot market, or futures if you are trading those. When placing a limit order, we need to tell the system how much we want to trade and the price that we want to trade at. So if you have got this type of layout, just come down here and make sure to click limit order. If you have got a right-hand sided layout, it's the same. You just need to choose limit order up here. Then we can choose if we are a buyer or seller. So the two things we need to tell the system are what is the price we want to trade at and how much do we want to trade. Current price. If you're selling, you place it above the current price. For example, let's say Bitcoin is trading at 50K and you want to buy it for, let's say, 49.5K. You place a limit buy order at 49.5 and the order will only execute if the price drops to that level. You don't need to buy a whole Bitcoin. You can enter an amount like 0.0005 Bitcoin and the system will calculate the total cost. Or you can simply enter the amount you want to spend, like $2,500, and it will work out how much Bitcoin you are buying. A limit order is just an instruction to buy or sell at a set price. However, if you enter the wrong price, you might not get the trade you expect. For example, if Bitcoin is at 50K and you place a limit buy order at 49K, the trade won't happen until the price drops to 49K. If you set a limit buy order above the current price, you're essentially placing a market order because the system will execute at the best available price. For example, if Bitcoin is trading at 50K and you place a limit buy at 51K, you will actually buy at 50K or the best available price since your limit is above the market. If that explanation just saved you from an expensive trading mistake, hit the like button. It's cheaper than a bad entry. For selling, the logic is reversed. You place a limit sell order above the current price to sell at a better price. If Bitcoin is at 50K and you set a limit sell at 51, your order will only execute once the price reaches 51K. But if you set it at 49.5, you are essentially saying you're willing to sell for less than the market price. So it will execute immediately at 50K, acting like a market order. Let's say you want to sell Bitcoin at 52K. You place a limit sell order and it will remain open until the market reaches that price. However, if you mistakenly place it at 48, it will instantly at the best available price. After placing your limit order, you can track them in the open order section where you will see details like order type and status. Now, you can edit these on Binance as well. So just click where the setting of orders are and you can edit the price and the amount that you are trading very easily for those orders. So as you can see, guys, we can also see the amount that's filled because we may get a partial fill, 50% of whatever, and then the total amount of the order. If you want to cancel these orders, just on the right-hand side, we can just cancel them both. And those orders are out of the system. Also, a note on trading fees when using limit orders. Some crypto exchanges incentivize users to input limit orders into their systems rather than trading market orders. The reason being is that limit orders create liquidity in an order book because your orders will fill the order book around the current mid price, giving liquidity and depth to the order book. And that is something that trading systems want. And so they may incentivize you to use limit orders rather than market orders. On Binance, trading fees are generally the same for most users, but higher volume traders and VIP members get rebates and discounts when using limit orders, also called maker orders. Instead of market orders, taker orders. This is because limit orders add liquidity to the order book, making you a maker, while market orders remove liquidity, making you a taker, and takers usually pay higher fees. Got any trading war stories? Drop them in the comments. Bonus points if they involve a fat finger mistake. BYBIT follows a similar model, offering incentives for VIP traders and those who trade large volumes. In futures trading, makers often receive rebates as well. Many other exchanges have a similar fee structure where maker orders cost less, making limit orders the cheaper option for active traders. So if you want to save on fees, limit orders are the way to go. They give you control over your entry price and cost less in the long run, especially if you're trading frequently. That's it for today. Trade smart, keep staking stats, and I see you in the next video, guys. Bye.